All right, we're going to finish off this section with the Marcus Trifecta, which is basically the analytical framework that we use to pick the best trades. So we kind of went over, why macro is so much different than any other styles and what they look at in general. And now we're finally going to introduce the analytical framework that you're going to use to really focus down and get to the best trades. So what is this? The Marcus Trifecta came from this guy called Michael Marcus, and he traded back at Commodities Corp in the 70s and 80s. Commodities Corp was a trading company that trained a lot of people back in that day in global macro, and so many successful people came out of that place. Paul Tudor Jones, who we talked about earlier, came out of there, and just countless others that we haven't had time to profile. But these guys learned a lot in there, and Michael Marcus was one of the most impressive traders there. He went from a $30K account to an $80 million account in just 10 years. All right. And by the way, this is him right here. So he made his money, though, by betting 5 to 6 times what he normally did on the very best trades. And he was interviewed in Market Wizards with Jack Schwager, and he'd tell Jack that, most of the trades are just for his amusement. The ones he really made his money on were the big bet trades where the fundamentals combined with the technicals combined with the market tone or otherwise sentiment. So there's those 3 prongs that you want to pay attention to. When they all line up is when the huge trend is going to come. So we got fundamentals. That's the first part of the framework. And we got the fundamentals. So supply and demand imbalance must be suggested. So that means that if a market has a supply and demand imbalance, the price needs to correct to put it back into equilibrium. Okay, that's basically what fundamentals are. Then we have the technicals. And the technicals are what's on the chart. So the chart has to show that price is moving in the direction that the fundamentals suggest. If it's not, then you have a divergence and it won't be as good of a trade. And then finally, you have sentiment. So sentiment is basically what the market crowd or what the market is thinking about that particular trading theme or trend. All right. And with sentiment, when news comes out, the market should act in a way that reflects the right psychological tone. So that means if you're in an uptrend and you're buying stuff, good news should really propel it, and bad news, should kind of be shrugged off. So with these 3 things, if you're seeing all of these aligned together, that's when you're going to get the big bets and the stuff that's going to pay off for you in size. Now, here's a little table I made kind of comparing the analysis types from 3 different frameworks, and you can see that, you can see that global macro basically combines elements from these other 2 methods. I got value investing, which is something that, Buffett does, and, he looks at fundamentals. And he doesn't really look at technicals, though. He doesn't really care about what's happening in the chart or what the trend is. And then he'll sometimes look at sentiment, right? Like value investors like to go to parts of the market that are hated to find the best deals. Trend followers, they don't even look at fundamentals. All they look at is price. So they're all about the chart. They're buying what's going up, selling what's going down, regardless of the underlying fundamentals. And they don't really care about sentiment either. But macro guys, these guys do care about fundamentals. They use the Marcus Trifecta. They do care about technicals, and they do care about sentiment. Okay, so macro utilizes everything. All 3 of these analysis types, and that's what we call the Marcus Trifecta. So, because the global macro universe is so large and so diverse, and there's so many things to choose from, and it's very complex, you really need these 3 layers of analysis to correctly filter down to the best ideas. Otherwise, you're going to be left with way too many potential investments, and that's just going to lead to decision fatigue. You can't have 100 potential investments. You got to really narrow it down to the best of the best, and you got to put it through 3 layers of analysis. So that's it for section 3. And we covered quite a bit of material in this section. I want to go over the main takeaways again for you guys. So, number 1, global macro investing trading is much different than conventional investing. And we went over for reasons why that is so. And primarily because, macro goes to any market. They'll trade anything in the world, both long and short. Global macro uses leverage and does not diversify. All right, so it it really likes to concentrate and find the best ideas and put most of the money into those ideas. Global macro traders look for the big themes and the top line data. They're not concerned with the micro fundamentals of a particular company. They're looking for broad things like profit margins of the entire S&P 500, not profit margin of a specific company. Macro traders do not get married to ideas. Remember, you trade it, don't date it. Absolutely cut losers and get the heck out if it's not working for you. And finally, global macro traders use three different types of analysis to find the best themes and the largest trends via the Michael Marcus framework. And in the next few sections here, we're really going to dig down into this analytical framework, into the meat and potatoes, and how you can use each of the analysis techniques to discover the best trends in the market.